Well, higher gasoline prices pushed inflation to 4% in August, but will the Bank of Canada be able to look through this acceleration in energy costs and keep interest rates on hold? Joining us now to discuss, Robert Both, macro strategist at TD Securities. Robert, welcome back to the program.
Thank you, Greg. It's always a pleasure to be back and to be able to discuss the outlook for the Bank of Canada and what Canadians can expect going forward.
Okay, so let's talk about that headline inflation to begin with. We had it sub 3% heading into the summer and a reacceleration on gasoline prices. 4% I think was a little bit hotter than most people were expecting. How do you read it?
That's right. It was only 2 months ago that inflation was actually 2.8% year over year. Now, at the time, we knew that inflation was going to move higher because of base effects that were caused by energy prices falling last year. However, the last 2 months have been much stronger than we or the market had anticipated. So instead of getting back to about 3.5% year over year, inflation is now running at 4%. It was up 0.7 from the 3.3% rate in July. And just the month-over-month increase, both the headline index and measures of core inflation rising about 0.4 month over month. So, this wasn't just an energy price story like we and some others had anticipated. It does seem to be a little bit more broadly based than that, and that is going to concern those at the Bank of Canada who have been highly concerned with the persistence of price pressures.
Yeah, because the headline is one thing, is it pushed around, you said, by volatile things like gasoline prices. But if you got core running at 4% as well, I think you guys put out a note this morning saying this isn't comfortable for the bank.
No, it's not going to make the Bank of Canada more comfortable. So even though we did see large contributions from gasoline, from heating fuels, electricity, inflation pressures were much more broadly based than that. We saw rent prices rebound a little bit. We saw more strength come through the mortgage interest channel. And then you also saw a little more pressure from some of those consumer goods that had been decelerating over the last few months. So things like clothing, furniture, appliances, parts of the economy where spending has been trending lower over the last few months. All of a sudden, price pressures are starting to reemerge there, and that's what helped drive the rebound in core inflation measures.
Now, apart from inflation, we had seen an economy coming weaker in the second quarter than expected, perhaps some cooling in the labor market off of its rather hot pace. We start taking all these things and mixing them together. We don't get another rate decision, I think, from the bank till next month. What do they need to be looking at heading into that one?
Right. So the next Bank of Canada meeting will be towards the end of October. So there is still a period where they can evaluate incoming data to decide whether or not the inflation shock, warrants potentially moving higher from 5%. In particular, we'll be watching the next monthly GDP report, which we'll get next Friday. That's July data. It'll also give us an early look at economic activity in August. We'll also get one more inflation report for the month of September. And then the last one we're going to get before the next Bank of Canada meeting, which the bank will be keenly focused on as well, are those Q3 business outlook survey and consumer surveys as well. So those just give us a better read on sentiment across Canada.
As I was looking through the TD Securities note about all of this in the print we got this morning, this line stood out for me. If the next CPI print is higher or at these levels, we have a hike warming up in the bullpen for October. So we actually think we're at the place now where if the data keeps moving the other way, the Bank of Canada will go again?
Well, I don't think it's entirely up to the next inflation print. I wouldn't put that much emphasis on it because we have seen more signs of slowing come through the growth channel over the last couple of months, and especially with that second quarter national accounts. So I think when you are seeing, the interest rates that have been delivered already having a more significant impact on growth, that does give us a little more confidence that inflation will break lower with time. But these upward shocks do provide some counter evidence to that, and there is going to be a limit to how much the Bank of Canada can tolerate. Now, if inflation proves more persistent and we see growth rebounding as well over the second half of this year, if that Q2 shock does look a little more like a one-off, then I would be more concerned about the the prospects for another round of Bank of Canada tightening. But I think they will take a more comprehensive look at the data over the next 6 weeks or so, rather than simply the next inflation report.
Over the past year and a half, this has been at a very aggressive pace of rate hikes, not just from our central bank, but from other G7 banks, the Fed as well. What is it that's happening here that we're not getting inflation coming down? I mean, is it the energy prices are external, right? We start talking about OPEC. Are there forces outside of our borders that even though we keep hiking the borrowing cost on us Canadians, us consumers, you're just not getting inflation where you want it to get?
So that's something that Governor Macklem actually discussed in his most recent speech. It's taken a little bit longer than we'd anticipated for rate hikes to hit economic growth. And just like it took longer than expected for that to occur, it's also taking longer for slower growth to translate into less inflation pressures. Now, one place I would look at right now is the labor market. We have seen some evidence of rebalancing in the labor market. The unemployment rate's about 0.6 percentage points higher than its cycle low. It's getting close to those levels where it's no longer putting upward pressure on wage growth. But the labor market is still exceptionally tight. If you look at job vacancies, the vacancy rate is still above pre-COVID levels, but we have seen it move closer to balance over the last 12 months. And once it does get there, I think we can have more confidence that we're not adding inflation pressures domestically. The Bank of Canada has much more scope to look through external inflation shocks than building excess demand, which was a key driver of the inflation we saw over the second half of 2021 and first half of 2022.